Starting this week again by looking at the CFTC data from Bank. Last week we saw continuous euro bullish bets building up. So there was a bit of a rally in the euro as well. And it's been increasing now to 16 billion. Canadian dollar bearish bets, so shorts been covering. And Australian dollar, New Zealand dollar very close to being fully neutral. Same thing with Mexican peso and Japanese yen. Bulls have been adding last week again. Same thing with gold. So it seems to be a direct theme going on. Quick look at the open interest as well. Again, open interest is important to look at to understand investors and speculators' enthusiasm for how they see markets. If they feel that there's a bigger move coming, you should usually see open interest picking up. Now it's at a 4-week low, which usually tells us the market is chopping about, which funnily enough it is. And having a look at euro as well. And euro open interest has been rising, funny enough. And there's 190,000 contracts long right now. Shorts have been adding, same as longs, but overall the net positive keeps remaining for the euro. Reason being behind euro bulls keep adding their position is that there's a tectonic shift happening in the eurozone where everybody tries to have collateral debt, and that brings everybody closer and integrates Europe closer, which is a positive long term for the eurozone. Hence euro is getting a lot of bids right now, and there's a lot of hope for recovery in the stock market and so on. So that's the key reason behind euro longs building up, and we should continue seeing, as long as the story behind the euro bonds holds, we should see these longs adding as well. And with a strong open interest, I expect euro rallies across most pairs should be fairly strong. Open interest in GBP has been climbing as well. However, going by positioning, it looks like shorts have been outperforming longs again. So there's a little bit of misunderstanding about what's going to happen with the Brexit negotiations. So it's very likely that these positions are going to stay around the minus 1 billion, 1.5 billion, as the UK and the pound is still negotiating their way to how to deal with Brexit. NZD and AUD fairly neutral. There is no positioning either way. Open interest extremely low on Aussie and NZD. So that means two things. That means there's no bullish or bearish thinking on the AUD or the NZD. It also means if you have another currency which is extremely strong or extremely weak, you can easily play it against these currencies, as they are unlikely to move either way. Which makes it easier, because usually when we do trade currencies and when we analyze them, we have to analyze both countries. Where right now you find it a little bit easier in this environment, there is less interest in buying or selling AUD. So if you pair AUD with any other pair, you have a fairly easier job by just analyzing one of them, not needing to be on top of both, as you usually would do as in the FX market. Japanese yen as well, open interest rising, not far off from where it was 9th of June. We had some really decent volatility back then. There was the week commencing where the Federal Reserve had the interest rate meeting, and there were some massive moves. So we should continue to see strong moves in the yen. And same thing with these other pairs. So everything's fairly consistent. There was no major changes from the last few weeks we've seen. Open interest noticeably picked up in yen, picked up in euro, and Canadian dollar shorts keep pairing their positions. So a lot of position squaring. This seems to be the only currency that's getting decent bids is the euro right now and the yen, which puts the US dollar at quite a negative. having a quick look at real yields, actually Treasury. I'm doing this video on the Monday. Usually I would do it on a Sunday, but I'm doing this on a Monday, so we have data for Monday as well. The real yields are -70, which is the lowest it's been all year, which is a huge positive for gold. So I'm having this real yield chart here. This is still updated from, I believe, Friday, so I wouldn't include this this -70 data point, but it's still very, very close. So I'm going to carry that over, have a gold overlay, just so we get a better picture. If it has escaped you, real yields are in inverse correlation with gold. So if I turn that real yield chart upside down and I overlay it with gold, change color as well, you find that real yields pretty much lead the way. So real yields at it's an inverted, but essentially it is at the lowest point of the year, and gold continuously climbing with it. There's no particular stop in sight where this should really stop, so this could easily climb towards 1.5, and that means gold will be jumping over 1800 an ounce. Basically what we're seeing is we see a trend continuation. There's no reason to believe there's a reversal going on in gold or real yields. Good to be on top of these. Gonna close that. Close that. Quickly showing you Danske research on the net cash flow for the euro. In this week, week 27, net cash flow is marginally positive, 0.5 billion, which isn't much. If you see the following weeks and the following weeks, the 5-week sum in particular, you find the most of July there is a surplus of 19 billion. That usually puts a little bit pressure on euro, which especially as we roll into July, which means that euro might be under pressure, might find it a little bit more difficult to climb as quickly as it has been throughout June. That is something that we will have in mind when we analyze the euro. But let's quickly go over to the calendar. In this coming week, the calendar is filled with a few good news, but there's 1 or 2 data points that are only important to us in this coming week and where we have a better grasp of it. The first thing everybody's looking at is manufacturing in China, the PMI. The big story last time was when the PMIs came. Was that manufacturers were worried that the global demand will slow down, and that will cause China to have a slower PMI as well, and they were really, really worried about that. And as data has been feeding through from the other countries, demand's been really slow to pick up as well. So we'll be really interested to see if that starts feeding through. If this number starts bumping up, I think we should see a risk-on rally across many assets, as there would be quite a positive outcome. But going into the event, I think there is a little bit of a degree of risk involved. I'm going to show you what happened last time that data came out, which was the 31st of May, on a pair which is probably more reflective of how that reacts. So back then we were in quite a strong rally, and AUD/USD actually didn't hugely react negatively. It started to base fairly quickly on that Sunday when the news came out into the Monday and posed a strong rally. So it'll be interesting to see how data turns out here as well. Right now we're quite in a choppy market, so there's no particular incentive to buy or sell. So that data point will be one to watch and to gauge how market is behaving, to figure out where we are leading in the short term, higher or lower. Next data point that is quite interesting and important for us is on Wednesday, and it is the US ISM manufacturing PMI. Last one that came out in June. I'm going to show you USD JPY as it reflects that data very, very strongly. The last time that data came out, bear in mind, we were in a risk-on rally, so everything was pretty much rallying, and that data, being good or bad, did not have a strong bearing on the currency. So on this red candle on the 1st of June, that data came out last time. We had a bit of a down move, but then fairly rapidly market started moving up, and it then climbed down 1 or 2 days before the FOMC meeting. Right now the environment we have is not hugely different. We are rallying into FOMC minutes coming this, I believe, Wednesday as well. So we're expecting actually good data, and there's been a lot of positive build-up behind that. We're expecting good data from the US, and that should propel most assets higher. So that's why we had this risk-on environment coming from Monday, and I'm expecting this to continue and snowball into the Fed minutes, which is this Wednesday. So we should have a risk-on rally. I'm expecting most yen pairs to rally. That means USD JPY, AD JPY should cause a rally going into those meetings, as we're expecting positive data. And FOMC minute, we are hoping to see a little bit more details about the yield curve control from the Federal Reserve. It is a shortened week, so the 4th of July holiday is coming up. That means NFP will fall on a Thursday, and the consensus is for unemployment in the United States has sort of bottomed out, and we're hoping to see a recovery starting, albeit very slowly. But again, that's feeding back into the positive environment. So we are looking for good Chinese data, we're looking for good US PMIs, and the Fed meeting to touch onto the yield curve control. That's all setting up for quite a positive environment to finish off the week. So ideally we will be looking at currencies like AD JPY to cause a bit of a rally. Even the USD could possibly rally if the data is showing that the United States is performing better than other countries. But all in all, expect most risk positive or risk sensitive assets to rally beginning of the week going into Wednesday, and then from there on we can sit and wait until the new story unfolds. So it's quite a shorter video today. It's not a lot to look at. It's mostly one story, which is the risk on, risk off moves. There's no other incentive right now to drive market. We are still in a huge choppy market across most FX pairs. So these little stories will be driving currencies until we have a bigger incentives to grasp, where we can see major breakouts. Hope you enjoyed that video, and until next time.